The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
This is Denise Nostrom, CEO and founder of Diversified Financial Solutions. Now more than ever, investment advice is needed. Not just where best to invest your money, but why. Are you investing for your future retirement? Are you retired and looking to maximize your income? Are you maximizing your income and concerned with leaving money for your loved ones? Are you investing for your retirement at the same time saving for your children's education and at the same time saving to buy another home? Are the markets in line with your goals? Are your goals ever changing? Please contact me at 631-758-8691. That's 631-758-8691, or visit us at diversifiedfinancial.biz. For over 25 years, I have been helping individuals, families, and business owners navigate through all market conditions with only one goal in mind, my clients. Visit me at diversifiedfinancial.biz or call Denise Nostrom, founder of Diversified Financial Solutions, at 631-758-8691. That's 631-758-8691 for a conversation about my most important client, you. Hello and good afternoon. Thank you for tuning in and spending some time with me today. Can you believe that it is the start of Memorial Day weekend? I am so excited. This is truly my favorite time of the year. And you are listening to The Financial Chick Show, and I am the Financial Chick. My name is Denise Nostrom. I am the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you want to know more about me or my firm, you can check out my website at financialchickshow.com. I'm also on Facebook and Instagram at Diversified Financial Solutions. So like the pages to get some updates and see what is happening. So I'm going to do just a little plug for myself, actually, right this moment. Yesterday, May 26th, was my 26th anniversary of Diversified Financial Solutions. So I've been at this for 26 years as an independent. Started the career with in some big firms, but went out on my own. And yes, I'll expose it. At age 27, I went out on my own and started my firm, and still loving it every minute. And here I am today, radio show and all. And so exciting stuff. And I still can't believe it's 26 years. It's amazing. But so I'm going to jump right into it today because I am super excited about having a guest with me today. I would like to introduce you all to Michael Ashton, who is the inflation guy. So Michael, are you there?
Yeah, I am here.
All right. How are you doing today, Michael?
Oh, doing great and happy to be here. Congratulations on 26 years as an entrepreneur.
Thank you so much. Yeah, it's amazing. You know, the first couple of years are always very challenging. Then you kind of hit your stride. I mean, it's always challenging, right? But it's a different type of challenging as the years kind of go by. But yeah, so you have a pretty impressive bio, and we were talking a little bit about the fact that after decades of modest growth with consumer prices, and people have been like not worrying about inflation, and until now, and so suddenly Michael Ashton, the financial, the inflation guy, finds himself super busy. So tell my audience a little bit about yourself and how you came to be the inflation guy.
Thanks. Yeah, it's funny. It's like overnight success after decades of doing the same thing, right? Mm-hmm. I spent a lot of time on Wall Street. Initially as a strategist, and then I became a trader. I traded options, for a bunch of the big shops, J.P. Morgan and Barclays, Deutsche Bank, Bank of Trust, that sort of thing, and at some point, I was tasked with sort of starting the inflation derivatives market when I was at Barclays, and they were the inflation house, and they felt like, they were the ones to start the inflation derivatives market, and for a bunch of reasons unique to me, I was sort of the right person to kind of do that, and it just turned out to be a wonderful thing for me. At that point, I became the inflation guy because I was the only one who cared about it. and back then, this is in, the early mid 2000s. And
okay, I was going to ask you what time frame are we talking about? Okay.
Right. So we're right in the middle of this low, stable inflation environment. But, what was important, I guess, to me at the time, what was very obvious was that unlike credit risk or equity risk, we're born into this world with inflation risk, right? Just by virtue of being in this world, you're exposed to a change in the value of the purchasing power of the dollar. And so it was very obvious that people didn't have protection against that. They didn't understand what those exposures were. And it was just the right thing for me to become an evangelist about and to spend a lot of time researching and developing how best to diagnose inflation problems and cure them.
Okay. Well, I guess for the listeners that are not really certain what inflation is, let's kind of start from the bare bones. I guess what would you say inflation is if you had to kind of give it a definition?
Yeah, well, there are a bunch of different ways to say the same thing, and essentially, inflation is a decrease in the purchasing power of your money. And so, $100 today doesn't buy what $100 did 2 years ago, and that doesn't buy anything close to what $100 did a century ago. Mm-hmm. And so that's inflation. We measure it in terms of how prices change, but that's just sort of the inverse of how your dollar is buying less. The reason it buys less is because prices are higher. And so those are two ways of looking at the same thing. Right. But we always think in terms of the price index, consumer price index, or the personal consumption expenditures index, and so on. But that's what inflation is.
All right. Well, I think everybody, like we were talking the other day, that, I mean, if I got $1 every time that I heard the word inflation on the news or on the radio, or even from my clients, and they usually don't use the word inflation, but what are they saying? My gas is up, my goods, my food, pretty much everything. I mean, we can't even just limit it. I mean, it's just across the board, everything is up. So I guess what really spurred this inflationary period, if you had to kind of pinpoint it?
Every part of the cause, lives in the Washington, D.C. area. We started with, profligate government spending to try to lift us out of or to paper over the COVID shutdown. Mm-hmm. And then the Fed sort of pitched in with spastic monetary policy, and either one of those two things by themselves probably doesn't cause the debacle that we have in inflation in this country right now. But you put those two things together, and you start mailing people checks, sizable amounts of money, and you print that money. That's the classic recipe for how you create inflation. And the only surprising thing is that it surprised people.
Mm-hmm. Exactly. Well, the few that were in the know knew that it was not going to be a good scene, but I don't think people realized the enormity of how bad it was going to be.
Well, and the interesting thing, and I guess this should be very surprising when you think about Washington and you think about how it's all about deflection, right? If it's my fault, I would just want to deflect it. All the talk about how these are supply chain problems, and they are supply chain problems, but they're supply chain problems that were caused by too much demand. The reason that all the containers piled up in the ports of Los Angeles was because all of a sudden we needed lots of stuff and we had the money to buy it. Mm-hmm. And so, normally when you come out of a recession, you have the production side of things, GDP, growing at about the same rate that personal income does, because if a company starts making more widgets, they pay people to make the widgets. The people who make the widgets take that money and they buy the widgets.
Right.
Not necessarily exactly the same thing, but those two numbers move together: personal income and GDP. If you go and you sort of look what happened over the last couple of years, they became totally decoupled. All of a sudden, there was lots more money out there than we were producing. Too much money chasing too few goods is the classic recipe, but that's why we had supply chain problems. Is because of this huge surge in artificial demand.
Yep. So it's interesting. I mean, COVID really spurred this. I believe this inflation. But were there any other factors? Maybe looking at the fact of oil, and we're kind of running to the break. So we'll touch upon this, but we'll touch upon it again after the break. But would you say that the fuel situation has been part of it as well?
Absolutely. And, there are things you can do with policy to sort of help the supply chain problem. But at the end of the day, it's, everybody has a hand in this.
Mm-hmm. All right. Yeah. So I'm here with Michael Ashton. He's the inflation guy, and we are talking all about inflation, which is the biggest concern everybody has today with gas going up and food and pretty much everything that we have. Airline, I'm here at the airport, airline prices, everything is kind of falling apart. So we're hoping to get some insight today on inflation and ways that hopefully the monetary policy or just what the government's going to do is going to make it better. So you're listening to The Financial Chick, Denise Nostrom, the company's diversified financial solutions. I help you look for financial solutions when you feel like there are none. Feel free to contact me at 631-758-8691. We'll catch you after the break. Welcome back. You are listening to The Financial Chick Show, and I'm delighted today to have a guest with me, Michael Ashton, who is the inflation guy. And big topic right now. Everybody's, feeling the pinch of the costs going up all the time. And, we're trying to find out why it's happening and ways to possibly mitigate it and get past this. So, Michael, you back with me?
Yes, I am.
All right. Well, welcome back. All right. So we were talking a little bit about, some of the things that caused inflation. I guess I had a question in terms of, the real inflation that we've seen lately. When was the last time that we had an inflationary scenario like this? You said it's been decades, but when was really the last time?
That's a great question. It's been, it's not since the very first years of the 1980s.
Okay.
Literally, and I looked this up with the census, literally half of all Americans living today have been born since the last time we had inflation this high. So just about 50% or so of all Americans were born since 1982 is, I think, the last time we saw the numbers this high. And obviously in the investor class, it's even a larger percentage that have just never seen this kind of inflation with respect to market and how they impact markets and how monetary policy has to change in that kind of environment.
Yeah, wow. So that's pretty amazing to think about that. So this is shocking to most people, and I don't think people are dealing with it well at all.
Yeah.
I see.
It's hitting everywhere. By the way, it's hitting everywhere. And that's, I think, one of the things which finally persuaded the Fed that it isn't transitory is that initially it was, used cars. It was one or two things,
True.
And now it's literally 80% of the consumption basket is inflating faster than 4%. So it's all your foodstuffs. It's all the energy. It's rent. It's medical care. Well, actually, medical care is one of the few things that isn't quite going up. But it's almost everything in the consumption basket. You were naming a few things before the break, but it's almost everything that you look around is seeing prices accelerate. And that's what inflation looks like.
Right. Yeah, because when you think about it, I remember my parents, when they bought a house in the late 70s, I guess late 70s, early 80s, their mortgage rate was about 14%. So we haven't seen that in a really long time. And most people, it's very interesting when I talk to my clients too, they're like, oh my God, mortgages are 5.5% now. And, I was getting 2.5%. I could have got 2.5% or 3%. So we're definitely going to see the real estate market change, I think. What are your thoughts on that?
Well, I think that you're definitely going to see a slowdown, and we're already seeing a slowdown in home sales. I don't think it's necessarily going to mean that prices in real estate probably, they're not going to keep going up at 20% a year. But I think that there's some people out there who think real estate prices are going to decline because of higher interest rates. And I don't think that's going to happen because,
interesting. Okay.
We've added 40% more money. And so your first guess should be that all goods and all assets should go up, something like 30 or 40% in price. Not immediately, but it'll take a few years. And so if you look at what's happened to home prices, they've gone up, a similar amount to that. So they're not ridiculously extended. But the other thing I would say is, you look at a 14% increase in home prices, which is this last week, what we saw in existing home prices, about 14%. In an environment of 2%, like we used to have, that would be just a huge increase, right?
Right.
But now we have 8% inflation. At 8% inflation, 14% is not as impressive. Mm-hmm. So although home prices have been really skyrocketing, and I think they'll come back down to earth, I don't think we're going to see them falling anytime soon. But we're all going to see traffic in that industry slow down. We're already seeing more cancellations of contracts and things like that, less foot traffic, and home builders are less optimistic and so on. But There's a real shortage in housing as it is, so I don't think, we're not going to see home prices and rents fall anytime soon.
Right. So how can we make our way out of this? Not that you or I have any control over it, but I mean, we know the Fed is starting to increase rates, but is that really the only way to get out of this inflationary period?
No, rates aren't a bad thing. I mean, we know that they've been artificially too low for a long, long time, right? And so for some time, it has made sense for the Fed to just let interest rates go up. But that by itself isn't necessarily going to affect you unless you're a highly levered hedge fund. A percent here or there is not big. If you're an entrepreneur and you're borrowing at 10%, suddenly borrowing at 11% doesn't really affect you. If you're a big guy borrowing at 2%, then maybe 3% bothers you. But what really needs to happen is we need to see the Federal Reserve needs to stop printing so much money, and they're already doing that. But next month they're supposed to start letting the treasuries that they hold on their balance sheet they're going to start letting them mature, and so the Fed's balance sheet will finally start to shrink. Mm-hmm. Now, in the past, whenever they did that, it meant really bad things for markets, and so they didn't do it for very long. But if we want to, if you want to have the water stop boiling, you need to take the water off of the stove.
Mm-hmm. Sure.
And the first thing you need to do is turn the heat off, and so that's what the Fed's going to start doing when they are letting the balance sheet run off. And we'll have to see how long that takes to let everything normalize. But I don't think it's not going to be 22. It's, we're going to see more normal inflation in 2023, but by more normal, I mean 4 or 5%. We're not going back to 2 for quite a while, in my view.
Right. So there is a light at the end of the tunnel then, huh?
Well, it's still a ways off, but yeah, I mean, I think that we do know enough at least we should by now realize that what we did coming out of COVID, that you can argue was necessary to get out of COVID, is no longer an appropriate policy going forward. And so that realization in and of itself, let's not run $5 trillion deficit. Let's not print the money to run $5 trillion deficits.
Right.
If we just stop doing those things, then inflation will not keep running at 8 or 9 or 10%. And hopefully we've all figured this out, and hopefully that's the direction we're going. At least right now, it seems like we are.
Okay, well, that's good news.
If markets continue to correct, that's when it's very easy for the Fed to talk tough when interest rates and the stock market are where they are. Mm-hmm. Knock them down another 20%, or go hike another couple of times, and then it's going to be much harder to be as brave. And that's where the rubber really meets the road. That's when we'll see how serious they are about fighting inflation versus saving lower markets or avoiding another recession.
Right. And it's true. I mean, again, we can have good markets and inflation, and we can have, like vice versa. It doesn't necessarily mean that because we have inflation that the market's not going to do well. They do kind of run a little bit. They will converge, right, where there's going to be some bad times, but they can, separate again, and then we can still have inflation and still have good markets, right? So it's just... I guess it's just a matter of what kind of path that it's going to go. I don't know. It's kind of interesting.
The problem is volatility. Yeah, the problem is volatility, right?
Yeah.
So we did something very spastic, and so it's hard to get out of that without volatility. Mm-hmm. if we gradually pulled back on the throttle, it's much easier to land than if you just suddenly cut the gas. And so that's the part. It's going to be difficult to do this without breaking something. When you suddenly turn off liquidity, things break. And so we'll just have to see what breaks and whether it's something that was worth it. But
well, it looks like we have a path to run on, and we have to watch closely to monetary policy and see what the Fed is doing, and just hope. But I want you to share with my listeners a little bit about your podcast, Sense and Sensibility. How can they get in contact, or how can they find that and find you?
Yeah, sure. So, I'm on all the podcast things. You can look for the Inflation Guy podcast. Sense and Sensibility is what you said. I'm inflation_guy on Twitter. And you can send me email at inflationguy@enduringinvestments.com. I'm all over the place. If you just look for Inflation Guy on the web, you'll find me somewhere.
Awesome. Well, we're at the end of the show, believe it or not. So thank you so much for joining me, Michael.
Thank you for having me.
Yeah, well, we got to do it again because there's so much to talk about. But everybody enjoy your Memorial Day weekend, and let's remember those that enabled us to enjoy our Memorial Day weekend. See you next week.
Advisory services offered through Blackridge Asset Management, LLC, a registered investment advisor. Securities are offered through Peak Brokerage Services, LLC, member FINRA, SIPC. Blackridge Asset Management and Diversified Financial Solutions are separate and independent entities from Peak Brokerage Services.